Jeff and Nancy, thanks for coming in. I called you in today so we can go over the education planning aspect of your financial plan. I know we're dealing with 4 kids here. We've got a lot of moving parts, so I'll just jump right into it. First of all, I talked to Ryan the other day, and he mentioned that he's taking some night classes, just trying to further his business knowledge to make him a better businessman. He did say he's not necessarily trying to get a degree, and he was wondering if he could possibly deduct any of the tuition he's paying at $500 per month. I looked into different opportunities, and I think the best thing that would suit him would be the lifetime learning credit. The benefits: there's no specific level of enrollment, so he should be able to take the credit. He actually gets 20% off the first $10,000 he spends every year on tuition. In his case, he's spending $6,000, so that credit would be $1,200. There is an income limit where it phases out between $55,000 and $65,000, but in his case, he's making less than that, so that shouldn't affect him right now. There is another credit out there called the American Opportunity Credit, but in this case, you have to be pursuing a degree or at least be half-time enrolled, and in his case, he's not, so the lifetime learning credit would fit him the best. Please relay that to him, and if he has any questions, tell him he can definitely call me whenever he wants. I can go over any details. Next, let's talk about Ashley. She's 12 years old right now, living with her mom. Jeff, you had mentioned that you'd like to pay for some of her college costs just out of discretionary income, and you were wondering, how much cost that was going to be for 4 years of college. We're using the assumptions that college is going to cost $25,000 per year in today's dollars, and it's going to increase by 6% per year, which is probably a pretty reasonable number. College costs have been going up like crazy. After doing the math, the future value of all 4 years of her college is going to be $155,136.89, to be exact. Obviously there's different types of college savings plans, which I'll go over when we talk about the twins. You mentioned that you just kind of like to give her money out of your discretionary income to help her college. In her case, we don't know if Susan's going to be contributing or what maybe her parents might be contributing. So, we kind of need to get a better number before we know exactly what you might want to think about putting away, or you can just help out however you can, once the time comes. Next, let's talk about the twins, Jeff Jr. and Emma. We wanted to use the same assumptions of $25,000 per year in today's dollars and same 6% increase per year. We also added the assumption in this case that we can make 10% on our investments in college savings accounts. There's a couple different options for education planning. They've got some years to go before they start. They're 4 right now, so that gives them about 14 years until the typical college age. So that gives you some, different options. One would be to start custodial accounts for each kids. This is kind of the way people used to try to plan for college. You can give money to your kids. Basically, you're transferring wealth to them, based on gifting limits of $14,000 per year. Anything above that, you would have to pay some gift tax. There's a couple negatives here. You don't get full tax deferral. You do get some tax savings because some of the money can be charged at the kids' tax rates. But once the kid turns 18, that money is theirs. So then at that point, they can do with it as they please. They don't need to use it for college costs. Some people, that's not a big deal because they trust that their kids are financially savvy enough to make the right decisions. But, kids can change a lot from when they're 4 to when they're 15, and that your opinion of that might be different at that point. So people are kind of moving away from using custodial accounts and moving towards college savings plans specifically. There are 2 out there right now. There's the Coverdell savings plan and there's the 529 college savings plan. Both of them are similar to Roth IRAs, where everything you put in is going to be after taxes. But anything you take out, as long as it's for some sort of education expense, is going to be totally free of taxes, so you never pay taxes on any of the gains. There's a couple differences. The Coverdell, for one, can be used for K through 12. It doesn't have to be used for higher education, so that's one benefit. The 529 does have to be used for higher education, so you would not be able to use it for private high school or something like that. Negatives of the Coverdell: you can actually only put in $2,000 per year per beneficiary. And so, even if Nancy's parents want to, put some money in or something, there can only be $2,000 going into that account every year, which obviously isn't a lot based on how expensive college can be. So that's a big negative of the Coverdell. Whereas the 529, you can do $14,000 per year without going over any gifting limits. Another benefit is that you can actually put $70,000 up front. They let you take a whole 5 years of your gifting limit and do that all at once to benefit the kid in the 529. That's one advantage. Most people don't have the money to do that, but it is an option, if grandparents want to give a bunch of money or something like that. One negative of the cover deal is that the contributions have to stop before the kid is 18 and has to be used by the age of 30. The 529 actually doesn't have those restrictions unless the plan specific has restrictions in itself, and there's a lot of plans we can choose from. So yeah, I mean, I'm honestly telling everyone that they should be doing 529s for their kids. I think this is the best option. For me, that's what I will do for my kids. Again, it's similar to a Roth IRA, so I think it's a big benefit to never pay any taxes on any of those compounding gains. The negative there that I have to tell everyone is that if for some reason you do take the money out prematurely, you're going to have to pay taxes on all the gains plus a 10% penalty tax similar to your IRA. That would be the same for the cover deal. Also, one other benefit is that you can actually transfer the money to any other beneficiary. So say Jeff Jr. goes and has a full ride scholarship and somehow doesn't have to pay for any housing or anything, which is also stuff that you can pay for out of these. Then you can actually take all that money and pass it on to Emma or any other beneficiary you like, a niece or a nephew. So that money is portable that way. So if you do decide you want to do something for Ashley and then, it turns out Susan covered her entire college cost, same thing, you take the money that you had in her 529 and pass it on to Jeff Jr. or Emma. So that's definitely a big benefit. That's what I would suggest. We did the math for them because obviously college costs are going to be compounding a lot longer. And for Jeff and Emma, it's looking like college costs will be about $247,265 total for the 4 years. Obviously this is a lot of money. We did a calculation and it looks like if you could put $7,651.64 at the end of every year into a 529 at that 10% return, you would actually reach this limit. I know that may seem like a lot of money, but you had mentioned, Nancy, that your parents have some money and they might be thinking about contributing. So, maybe you want to talk to them and see what they're really thinking about, and then you just need to make the difference. And obviously, guys, college planning is great. We want to help our kids the best we can. We want to help them get through college, but obviously it's not necessarily reasonable for everyone to think they can pay for the entire college expense for their kids with college expenses as crazy as they are these days. So I always tell my clients, the point is that we want to help as much as possible. You don't want to put yourself into poverty because you're putting so much money in this 529. You want to worry about your retirement plans first, and then if you have extra income, feed the 529s, maybe do a monthly withdrawal of $50, $100, but try to get as close to that number as possible if you really want to help them that much. And again, that's from all sources. You can tell grandparents, hey, at Christmas, maybe if you want to give them something, maybe give them a check for their college savings. They might not appreciate it now when they're 4, but I guarantee you they'll appreciate it when they're 20. So, every year we should kind of see where we're at and then reevaluate and see, how we can adjust our limits that we're contributing to try to reach that goal. If you have any questions, please let me know. That would be my suggestion. And, now we can move on to retirement planning.